Everyone's calling SCHD the perfect dividend ETF, but hear us what they're not telling you. It has underperformed the S&P 500 by over 20 percentage points in the last year. Before you dump your life savings into this fund because some influencer told you to, you need to hear the full story. Let me show you what's really going on. What's up, investors? Today we're having a brutally honest conversation about SCHD, the Schwab U.S. Dividend Equity ETF. As of January 12, 2026, this fund manages over $74 billion in assets and is trading at $28.50 per share. It's beloved by dividend investors, praised by retirement gurus, and recommended constantly on social media. But is it actually the best stock to buy now, or are you falling for the hype? I've spent days analyzing its 2026 performance, comparing it to alternatives, and digging into what Wall Street analysts aren't saying publicly. By the end of this video, you'll know exactly whether SCHD belongs in your portfolio or if you should look elsewhere. Let's get into it. What is SCHD and why is everyone obsessed? Let's start with the basics. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which holds 100 to high-quality dividend-paying companies. As of January 2026, it's delivering a dividend yield of 3.8% to 3.99%, depending on the source. That's more than double the S&P 500's 1.5% yield. The expense ratio is a ridiculously cheap 0.06%, meaning you pay just 6 cents per year for every $100 invested. The fund's top holdings include Bristol-Myers Squibb at 4.25%, Merck at 4.20%, Lockheed Martin at 4.20%, ConocoPhillips at 4.16%, and Chevron at 4.07%. Sector-wise, it's heavily weighted toward energy at 20%, consumer staples at 17.8%, healthcare at 16%, and industrials at 10.9%. These are mature, stable companies with long dividend histories, companies that have paid dividends for at least 10 consecutive years. Here's why people love it: reliable quarterly dividends, quality companies, ultra-low fees, and a focus on dividend growth. For retirees or income investors, those quarterly checks hitting your account feel like a paycheck. But here's the truth nobody wants to talk about: the performance problem nobody mentions. Let's be real about SCHD's recent performance, because this is where the narrative breaks down. Over the past year ending January 2026, SCHD returned approximately 6.1%. Meanwhile, the S&P 500 returned over 23% in 2024 and continues climbing in 2025. That's a massive performance gap. Year-to-date in 2026, SCHD is up about 4.1% through mid-January. Not bad, but again, it's trailing growth-focused indexes. The 3-year annualized return is 6.4%, and the 5-year return is 8.7%. These are decent numbers for a dividend fund, but they're nowhere near what you'd get from a broad market index or growth-oriented ETF. Here's what's happening. SCHD's defensive sector allocations: energy, consumer staples, healthcare protect you in downturns but limit upside when tech and growth stocks are soaring. In 2026's market environment, where AI stocks and megacap tech continue dominating, SCHD feels like driving a minivan in a Formula One race. It's safe, reliable, and boring, but you're getting lapped. The valuation tells the same story. SCHD trades at a P/E ratio of about 13.5 to 16.7, depending on the calculation method. That's cheap compared to the S&P 500 SP/E of 25. But cheap does not always mean opportunity. Sometimes it just means slower growth. What makes SCHD different from other dividend ETFs? Now, to be fair, SCHD isn't trying to beat the S&P 500. It's designed for income, not capital appreciation. Compared to competitors like NOBL, the ProShares S&P 500 Dividend Aristocrats ETF or VYM Vanguard High Dividend Yield ETF, SCHD actually holds its own. NOBL has a 0.35% expense ratio, almost 6 times higher than SCHD's 0.06%. VYM offers a lower 2.45% yield compared to SCHD's 3.8%. HDV, the shares Core High Dividend ETF, yields 3.2% with a 0.08% expense ratio. So if you're comparing dividend funds specifically, SCHD wins on cost and yield. The fund's methodology is also smarter than many alternatives. It doesn't just chase the highest yields, which can lead to value traps and companies about to cut dividends. Instead, it screens for financial strength, cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. About 85% of SCHD's holdings have at least 10 years of consecutive dividend growth. This discipline protects you from dividend cuts during recessions. The hidden risks Wall Street doesn't emphasize. Here's where we get to the stuff nobody talks about. First, sector concentration risk. With 20% in energy, you're betting heavily on oil and gas companies like Chevron and ConocoPhillips. If oil prices collapse or if the transition to renewables accelerates faster than expected, that 20% allocation could drag down returns significantly. Second, SCHD has essentially zero exposure to the technology sector that's driving market returns in 2026. Yes, it holds Texas Instruments at 4%, but that's old-school semiconductor manufacturing, not cutting-edge AI chips. You're missing out on Nvidia, Microsoft, Apple, Google, and Amazon, the companies actually generating the returns everyone's talking about. Third, dividend taxation. If you're holding SCHD in a taxable account, those quarterly dividends are taxed as ordinary income at your marginal tax rate. If you're in the 24% federal bracket, you're losing nearly a quarter of your yield to taxes. This is a massive hidden cost that dividend influencers rarely mention. SCHD works best in tax-advantaged accounts like IRA letters or 401ks. Fourth, inflation erosion. SCHD's dividend has grown at about 9 to 10% annually over the long term, which is solid. But in 2026, with inflation still elevated, a 3.8% yield doesn't stretch as far as it used to. After taxes and inflation, your real return could be close to zero or even negative. Analyst consensus and price outlook for 2026. Now let's talk about where analysts think SCHD is headed. According to TechRanks, SCHD is rated as a moderate buy with an average price target of $31.03, implying about 8.7% upside from current levels around $28.50. That's modest appreciation, fine for an income fund, but nothing exciting. Fund flows tell a positive story. In the past 5 days, SCHD saw net inflows of about $93 million. Over the past month, it attracted nearly $985 million in new money. Year over year, net flows hit $5.67 billion. Investors are clearly voting with their wallets, piling into SCHD as a defensive play amid market uncertainty. Several analysts view SCHD as an outperformance candidate for 2026, specifically because falling interest rates could widen the yield gap between dividend ETFs and bonds, driving more capital into funds like SCHD if the Federal Reserve cuts rates further in 2026. That thesis could play out. Is SCHD actually a stock to buy now? Here's my take. SCHD is not the best stock to buy now if your goal is capital appreciation or beating the market. It's simply not designed for that. But if you're within 10 years of retirement, if you need current income to cover expenses, or if you want a defensive allocation that smooths out volatility, SCHD absolutely deserves consideration as a stock to buy now. The fund's strength is stability, not excitement. It won't double in a year, but it probably won't crash 30% either. The 3.8% yield is real, reliable, and grows over time. The 0.06% expense ratio means more money stays in your pocket. And the focus on quality dividend growers protects you from companies that cut distributions during tough times. Here's what SCHD is not: a get-rich-quick vehicle, a market-beating growth fund, or a replacement for diversified equity exposure. If you're young and have decades until retirement, putting 100% of your portfolio into SCHD is probably a mistake. You're sacrificing growth for income you don't even need yet. But for someone building a retirement income portfolio, SCHD is a legitimate core holding. Pair it with some growth exposure, maybe 60% SCHD, 40% VU or QQQ, and you've got a balanced approach that delivers income while still participating in market upside. Here's a strategy I'm seeing more retirees adopt: the dividend ladder. Instead of going all in on SCHD, they're splitting dividend exposure across SCHD for U.S. large-cap dividends, VYMI for international dividend exposure, and maybe a small allocation to JEPI for enhanced income with an options overlay. This diversifies your income sources across geographies and strategies. If one region or strategy underperforms, you're not completely exposed. Also, consider rebalancing annually. If SCHD outperforms and grows to 70% of your portfolio, trim it back to 60% and deploy the proceeds elsewhere. This discipline forces you to sell high and buy low systematically. Remember, all investments carry risk. Past performance doesn't guarantee future results. SCHD could underperform further if growth stocks continue their run, or it could outperform if we enter a recession and defensive stocks shine. This is educational content, not financial advice. I am not a financial advisor. You must do your own research and consult with a licensed financial advisor before making investment decisions. Never invest money you can't afford to lose. And understand that dividend-focused strategies come with trade-offs. So there's the truth about SCHD that nobody tells you. It's a fantastic dividend fund with low costs, quality holdings, and reliable income, but it's not a magic bullet. It won't beat the market. And it comes with hidden risks like sector concentration, tax drag, and opportunity cost. For the right investor, someone prioritizing income over growth, SCHD absolutely deserves a spot in your portfolio. But don't blindly follow the hype. If this video gave you a more balanced perspective on SCHD, smash that like button. Here's my question: are you holding SCHD in 2026? Or have you found a better dividend strategy? Drop your thoughts in the comments. I read every single one and respond to as many as I can. And if you want more honest, no BS stock and ETF analysis like this every week, hit that subscribe button. Let's build wealth together with clear eyes and realistic expectations. See you in the next one.